Hi guys, my name is David Poppe, and I want to take some time and talk to you about one of the biggest things I run across every day when I'm talking with clients, and that's about the credit pull. Oh my goodness, the credit pull. One of the things that happens in a mortgage is we do have to look at how credit relates to, or your credit score specifically relates to what kind of mortgage we can get you into. There's different programs that affect that. FHA has certain guidelines, conventional loans have certain guidelines, VA, HomePath, 203Ks, they all have specific guidelines we have to follow, and a lot of those are based on credit. Obviously, the better your credit is, the higher your credit is, usually you can get some better rates or some better opportunities, some better loan options. But in order to do that, I do have to look at your credit. So one of the biggest things I hear from clients is, you know what, I don't want you looking at my credit, you're going to affect my credit score when you do that. So let me kind of explain to you about what happens during the process, or what happens when we're trying to look at your credit report. There's two different ways to look at a credit report. It's called a soft pull. The soft pull is where we look at one credit bureau. You know, there's three of them. We look at one credit bureau, and when that's pulled, it basically just gives us a score. It doesn't show us anything in your history, okay? Usually it doesn't affect your credit. If we decide to then pull a hard credit pull, which is what we usually do to put a loan package together for you, we're going to pull from all three credit bureaus. Now, a credit bureau is going to look at that pull, or that credit report that we're pulling from, and go, okay, what are they doing with this, and why are they pulling it, okay? If, as a mortgage company, I pull your credit, and you call 127 other mortgage companies tomorrow or today, and they pull your credit report, guess what? Nothing's going to happen with your score. What they realize is that if you have a mortgage already, you're trying to do something better with your mortgage, okay? You're either trying to refinance it to lower your rate, lower your term, save some money, okay? So they know that you're not trying to get additional credit. Now, if you go to 3 stores today, and you decide to get a new credit card at Macy's, at, whatever, that will affect your credit score a lot, because what you're trying to do is actually increase your debt load, okay? So keep in mind that if you're going to now do a purchase, you don't have a house, you don't have credit right there. That will affect your credit score the first time it's pulled, okay? Whether it's from a mortgage company, a mortgage broker, a mortgage lender, direct lender. The nice thing though is once that's pulled the first time, you'll have a hit of probably 5-10 points, okay? That's not a big deal. But if it is, once that's pulled and you're doing a purchase, that's actually good for 45 days. So at that point, you could have 972 other mortgage companies pull your credit, and it won't affect your credit score, okay? So keep that in mind. One of the important things for me to use is your credit report. It's not going to affect your score if a mortgage company does that, all right? If you have any questions, my email is below. I look forward to talking with you soon. Thank you.